coming to you for our financial literacy community outreach event. And so right now we're going to open up and discuss some subjects that are very dear to the heart, and when it's coming to our children. So right now we're going to deal with the protect them for life. We're talking about child gifting, and we hope and we pray that this is going to truly open up your eyes and illuminate some things to you. All right? And if you guys have any questions that are in the room while we're doing this, just reach out and stop me, and we'll stop and talk about it, okay? So we're dealing with protect them for life, with a gift they'll never outgrow. You know, a lot of times we don't understand. We can buy our children the clothing, the shoes, the cars, all of the different gifts and trinkets, the technology. But let's give our children something that's going to create an inheritance and leave generational wealth that's going to build, that you can pass on for 3 generations to come. Give me just a moment here, guys. I got to go back one. Hold on, I jumped. Oh, all right. Trying to get back to my other slide. Hold on, guys. Having a technical issue myself. Thank you. All right, we're all good now. Maria has saved me. She's come to the rescue. So, let's ponder on this. Do you have a little one that means the world to you? How many of you can really relate to this? That you have children, some may be grandparents, you may have grandchildren. What are you leaving for them? Is there a gift that you can give to them that's going to last a lifetime? Let's think about that. This is what child gifting is about, and it's so important. There are so many people that have missed out on generational wealth building. I can relate to that because this was something that was not taught in my household nor in my community. So this is why Maria and I are deciding to get out into the communities and to reach out to those that may not have been trained or taught this when they were coming up as children. Okay? So think about this while this presentation is going on. And those that are here in the room, you're going to be able to write down some information. You're going to be able to leave with some information. But to those that are out there in virtual land, you'll be able to contact me as well on our Kingdom Strategist with Rosemary C. Neverson page on Facebook, as well as my link there that you can go to my website and you can leave some information and I'll reach back out to you. Okay? It's my New York Live website. All right, let's think about this. What gifts do we usually give our children? We touched on this earlier. So a lot of times we're spending money into something that's not going to last. Children, they outgrow clothing. So we can buy clothes this year, and within 3 to 6 months, guess what? We paid money, and it's not going to be anything beneficial. It's not going to be anything that's everlasting. So we spend money into clothing. So we can buy the toys and the trinkets, but once we buy the toys and the trinkets, they even outgrow those things. So think again, what is it that I can give my child that's going to be here far beyond my lifetime, when I'm gone, when their children are coming up behind them? Things that they can create a trust or anything, you know, pass on the wealth. So then we think about, we give them monetary value, or gifts that have monetary value. So we go and buy a nice car. They go out, they're joyriding with friends, all of a sudden, they hit something. Then guess what? You're going to be responsible as a parent because you're the one whose insurance they're on. You're the one that's going to be held liable as a parent. So let's think about this. Who's going to be responsible for paying for that car, for paying for someone that may have gotten injured in the other vehicle? So we think about the clothes, the toys, the money. So when we're thinking about child gifting, let's think about giving something that can last a lifetime and beyond our lifetime. Now, 20 years from now, let's think about this. 20 years from now, what are these kids going to remember? What gift can we remember that we've gotten from our parents 20 years ago? Was it a car? Was it some type of toys, clothing? What is it that you've gotten from your parents that you're able to remember 20 years from now? Okay, 20 years ago, my dad bought me a Mustang. 20 years ago, I got a PS5. But it has no monetary value. Excuse me, I do apologize. Check my phone. No, the one, I know what it is. Excuse me, guys, live. It's the other phone. Bring it to the lead. All right, so we think about that 20 years from now. What is it that we're going to remember? But think about this. What if you could give a gift that would never be outgrown or wear out? You're not going to wear it out. It's not going to lose its value. That is guaranteed to increase in value. It will not become obsolete. It won't lose value in any economy. And you will always be remembered for this gift. Think about that. They're never going to outgrow this gift when you're dealing with child gifting. The value is guaranteed to increase, never becomes obsolete. So it's never going to lose that value, guys, in any economy. And they're always going to remember that you've invested in them for a lifetime. All right? Let's talk about the gift of whole life insurance. When we're talking about the gift of whole life insurance, it never wears out. It can't be outgrown. It won't lose value. It is guaranteed to grow, and it's the gift that keeps on giving. See how I threw that in there? It's the gift that keeps on giving. So when we think about life insurance, think about whole life insurance. Whole life insurance is a permanent insurance. What does that mean? It means that when a child is born, I wish I had known this, when a child is born 24 hours old, 1 day old, you can put a policy in place of a whole life insurance, and it's literally pennies on the dollar. It's very inexpensive, but it's going to be there for their lifetime. It's going to build cash value, cash asset. All of this is going to be building like a savings account, as Maria tells me all the time when she's trading it. And so that's something that's going to keep on giving to them. That's something that they can go back when they're 16. You can say, oh, you know what, I want to get a car for them. So if you put this in place from day one when they're born, 1 day old, then by the time they're 16, you're going to have all of this cash value. You can go and pull from it, say, let's get a car. Let's get something that's not too expensive, but their first car. Why? Because 2 or 3 years later, you're going to have to come back, and you're able to pull again to send them off to college. The money is still growing. But you think about it, that's been 18 years of accumulation. Sounds good? Mm-hmm. All right.
You got the money to pay for it.
Yeah, for the whole life insurance. But listen, that's how you get it when they're 24 hours old, when they're younger.
But you got to pay a mortgage for it every month.
Yeah, you got to pay every month.
It can increase.
Mm-hmm. But you know the good thing about that, Cardini, is this. The younger that we are when we get the insurance, the cheaper that it is.
Yeah.
That's the thing.
Well, they have my grandchildren and something like that now.
Mm-hmm. Yeah. Yeah.
Yeah.
I remember we talked about that. Yeah, I remember. Oh my goodness. All right. So let's talk about what it means for them. What does this mean for your children? What does this mean for your grandchildren, for your loved ones? The first thing it means is that it establishes a lifelong insurability. Let's talk about that. I was just touching on that. So if you get a child, you know someone who's had a child. The child is 24 hours old. You know, they're born today, by tomorrow, this time, they're 24 hours old. They put a whole life insurance on them. It doesn't matter what happens between the time they're born and you have that policy put into place all the way up until they're 30, 40, 50, as long as it's still in force, you know, guess what? There's no problem with having insurability. So that's why they say lifetime insurability. Because anything that happens between birth to 30, 40, 50 years old, as long as that policy is in force, they can't do anything, it's still going to be a lifetime insurability. The second thing is that it grows cash value from an early age. We were just talking about that briefly. If you have a child that's a day old, a year old, 2 years old from the time that you have that policy put into place, it's going to begin to grow cash value. You're going to be able to see that in the accumulation by year 2 is where we start seeing that cash value begin to trickle down. You'll see it building like a savings account. The third thing is that it offers access to money that is generally, this is it, tax-free. This cash is tax-free for major life expenses, like we were talking for college. If you're getting ready to send your children to college or help your grandchildren, if you're getting ready to buy a home, tax-free. Retirement and leave a legacy, this is all tax-free money in your policy when you have a whole life.
Excuse me, Rosemary. Can you, if you pay your premium monthly, at the end of the year when you file your taxes, is that a credit that you can also use for the monthly premium that you pay?
Yes.
So, how would you do that? Would New York Life send you a statement so then when it's your tax season, you can claim that, and would that be a deductible? Or does it have to be a certain amount of money to use in order to use that deduction?
Maria, I'll let you answer that.
So that's a really good question. It
want the microphone?
depends. Can you hear me? You guys hear me?
Yeah.
Sorry.
I don't want you to scream.
Thank you. No, I'm good. It depends on how, for example, let's say you're a business owner and you're paying premiums to an employee or yourself who's an employee of the business. You can deduct that in your taxes as a business expense. So it depends on the way. Here's another one. Maybe you do it as a gift to a grandchild. Maybe you do it as a donation, the premiums, because your beneficiary could be the church. So maybe your premiums are a donation. So depending on the way that you're putting those monthly premiums away, there are ways that you can have those be deducted in your taxes every April. Yes. So it depends. It could be sometimes yes, sometimes no.
So you're saying that it doesn't have to be a certain amount of money in order to use
No.
it as a deduction?
No, the amount doesn't matter. It depends the way that you're, if you're contributing to a business, if you have church, a non-for-profit as a beneficiary, those premiums are deductible, tax deductible, because it's a donation. So it all depends on how you, and I would say definitely work with your accountant on this because they would know better. Because if you, I see where you're going with this, it's a good question, because now you're double dipping, right? Right? Yeah, because whenever you take out the money, it's always going to be tax-free all the time. And then for a kid, what Rosemary's saying here, lifetime insurability, God forbid, onset diabetes for a child. It doesn't matter. They're insured for the rest of their lives,
Yes.
no matter what. So it's so important.
I like it. It's nothing like teamwork. Teamwork is dream work. Thank you for the questioning, Bob.
Really good
Appreciate
question.
you. I like that. Thank you, Maria, for the clarification. All right, so any other questions that we're talking about on this slide? You guys good?
All right, I'm gonna ask you a question. I had to put my grandchildren in your interest.
On some insurance?
What they gonna ask me for?
That's a good question.
What are they gonna ask you for?
Yeah.
Well, when we do the policy, as long as the children are under 18 and you're doing it as a grandmother, we can do it. You would be, they can't own the policy, so it would be their policy, but you would have to own it until they're 18 years old. And then also, if there's anyone else, like if you and Tony wanted to do it, you know what I mean? If you guys want to share it, and we can put you on, we can put him on like a secondary split 50-50. You would be the payer, you would be beneficiary on that. And you will be owner until they're 18. Yeah, and another thing is, if you and Tony are on there, you can also get like a contingent beneficiary. So if anything were to happen to either one of you, like if you still had the policy, you haven't turned it over to them when they got to be that age, 18 or older, then if something were to happen, you can make sure that the money's gonna go to the little ones like it needs to. And rather than having to like, say, the contingent is Justin, Sharon, something like that, you can pick somebody else.
And the beauty of this plan is the flexibility.
Yes.
So let's say the grandchild, the child, hangs out with the wrong crew, goes the wrong path in life. It could happen, right? You do not have to give them ownership if you don't want to at 18. You can keep your money if they go the wrong path. If they're a good citizen, you can say, congratulations, you're 18, here you go. Now it's on you,
Just keep
but you don't have to. So you keep control until that time comes.
And just past 18, well, that means they won't. If you want to give them a policy.
If you want to, yeah, you can. Absolutely. It's your choice. So you have a lot of choices, and it's very flexible. Thank you. Okay, thank you. Makes sense?
We're trying to save that voice.
Should
We're not gonna have any training today.
have heard me a week ago.
I know you sound a lot better, but that's why we're gonna bring the PA so she can have the microphone when she needs to talk.
Well, Rosemary, before you move on, my question is this. With her being the grandmother and her husband is the grandfather, these kids has a mother. So my question is, would she have to have permission from the mother in order to be the beneficiary of it?
You would have to talk to Sharon, let Sharon know that you went, well, I won't call them names, talk to your daughter, let your daughter know that you and your husband want to put insurance on your grandchildren, so that she can give you permission, but still, you would be the beneficiary, you and your husband, and you would be the payer. You just have to have her permission, that's all.
Now, Maria, you said at 18, they could, if they wanted to, they can get the policy?
Yeah,
But supposing that they're not mature enough to handle the policy, okay, couldn't they still get it because they are the beneficiary? No, they're the
Parent,
no,
insured,
they're the insured.
person.
you don't have to. Because in a policy, you have 3 different parties. Party number 1 is the insured,
Yes,
which is, in this case, the baby,
The baby.
kid, right? Party number 2 is the owner. Totally different, could be a totally different person.
yes,
Okay, the owner, let's say God forbid the owner passes away, there's no benefit to that. Because the owner is not the insured, 2 different people, okay? Party number 3 is the payer. So a lot of times we see situations where the insured is the child, the owner is the mom, the payer is the grandma.
yeah, we see that.
Is it written up that way? Is that what you said?
You can't do it like that. Yep. And you never have to transfer ownership to the
No, you don't
child.
have to. I know where she's going with it. You gotta make sure they're mature enough to handle it if
Right.
something were to happen financially.
She has this question for
Yeah,
you.
that's the question.
Let's say I give my grandchildren 4 policy. Their mother alive, their father alive.
Okay.
I'm paying for the policy. But like y'all say, I have to let the mother know. Something happened to me how will these policies remain paid?
That's
Who
a
will remain paid?
great question. That's a great
Because
question.
they get a certain age.
So whenever we put an owner, we have the option to put a successor owner
Yes.
in the application. Or afterwards, after you get approved, a successor. So let's say you say, okay, if God forbid I pass away before the policy's paid up, I'm gonna have the mother become the owner. Somebody you trust, it doesn't have to be the kid,
Yeah,
the owner.
yeah, you assign who you
You
want, that
assign.
you can trust.
Yes.
So when you write it, that's the way you have to write it. Is that what you said? Or
Yes.
could you add it on down
You
the road?
can add it on down the road. So in the application, let's say you have an idea today and you want to do it this way. You get approved, it's been 2 years. You're like, you know what? I want to change the ownership. I want to change the way. Flexible. You can change
You
it.
can do that.
Change beneficiaries anytime.
Yes.
Change ownerships anytime. Change dividend options anytime. Rosemary's going to talk about dividends.
Thank you.
Okay? Now, we can also do, what is the one, Maria? Not the disability waiver premium, it's another one for like the children.
The payer protection
Yes,
option.
yes, that one.
Like if God forbid the payer passes away, the policy will continue to be paid. It's a rider. It costs a little bit more, like I don't know, a few more dollars, but that is a rider you can add if the payer God forbid passes or the payer becomes disabled. You can't pay the policy. The policy will pay itself.
Yes.
Oh,
Payer
Yes.
protection
don't
option.
have nothing to do.
Right.
I knew that's why I wanted her to hear that. Because I wanted her to have peace of mind, because we talk about the disability waiver premium, and it's like if it's 6 months down the line and something happens with it, and you're down for 6 months, then the policy will automatically pay, it won't cancel. So you have that, that's also a rider. The dividend option we have is when we're doing a policy, say it's a whole life policy, or even a term policy, and you decide that, you know what, I've got a mortgage that's $300,000, and I've got 15 years on the mortgage. We can do a rider, like and use the dividends. The dividends, it's a yearly amount that kicks back into the policy. Because remember, we're a mutual company, meaning that everyone who gets a policy with New York Life is like you're an owner with New York Life because you own a part of the company. We don't have shareholders, we don't have stockholders. Okay? So with the dividend option, you can click the dividend options when we're doing the policy. And when we do that, the money that you're going to get, the yearly kickback into your policy that helps to build the cash value, you're actually going to get the dividend back that's going to help you pay for the policy. So, like, say you have a whole life that's $100,000, and then you decide that I'm going to use the dividend option to also put a term on for the $300,000 for the mortgage for 15 years of a level term. Okay, the level term, say it's $30. And then maybe the dividend option is coming in, it's going to help pay for that. You may pay just the offset of the value of the dividend that you're going to have that's kicking back into the policy, so it helps to pay for that. You see what I'm saying? I don't want to give a specific dollar amount because it does vary by the amount. All right, good, y'all good. I feel like I'm on the something. Look at that. For real.
My daughter's company, you know, kick some policy, won't overcharge you.
No, girl, no. We gonna talk today. We gonna write some stuff down. Yes. All right. So, what it means for you? What it means for you to have a gift for your children? In the means of a whole life policy, it establishes your legacy with this selfless gift. Maria showed me a letter, and I cried. Philip, I want you to do something with your wife. She showed me a letter, and I got some of the examples here in my computer, but the letter she sent to me to show me, it broke my heart because it was, and I'm going to try not to get emotional.
You should pull up the letter.
Girl, if I pull up the letter, we'll all be crying in here. I'm trying to hold myself together. But the letter was literally, it was from like a mother or a grandmother saying that, you know, in other words, I'm going to paraphrase it because I can't go into that letter, it's serious. But it's telling the recipient, that is your child, your son, your daughter, or your grandchild, that this, you know, you've gotten this policy, this is a gift that you're giving them that's going to last a lifetime. And so when she sent me that letter, I'm over there crying, like, why would you do this to me? Why would you send this to me? Because I got emotional. But it means a lot because what you're doing is establishing a legacy. You're establishing a legacy for your children, your grandchildren. And it's something that's going to be the gift that keeps giving. Financially. It's going to help them become financially sound, financially able to do what they want to do. They may want to purchase a home. They may want to take a trip. They may want to go back for a doctorate degree or something like that. So they're going to have that opportunity to do it. Okay? So, do something for your child you love that the child cannot do for himself or herself. Think about this. That the Lord gives us our children. And we're entrusted with these children's lives from the time of conception. Y'all will make me preach in a minute. I felt this shift. Okay, so anyway. So when we think about this, we've got our children. Hey, overseer! We have our children. And we're investing in our children. We're taking care of our children. We're nurturing our children. We're raising our children the best way we know how. And then when we do all of these things, we understand that we're doing something for our child that our child is not able to do for themselves. So we're taking care of our children. All right? We provide the child with a substantial and meaningful gift for which you will always be remembered. See, they had to put that on this slide. So think about this. Long after we're gone, I'm going to use you, Carter. You're talking about your grandbabies. Long after we're gone, you're gone, and tonight the kids are still there. They're going to look back and they're going to say, yeah, we're not going to claim it, but I'm just saying. And they're going to look back and they're going to say, you know what? My grand gave me this. She put this in place for me. I'm able to get a home because she put this policy in place. I'm able to go to college because she put this policy in place for me when I was just a little girl. You see what I'm saying? So they're always going to be very appreciative. That you may not really hear it or see it in their actions, but they're going to be appreciative because they're going to know that you love them enough to make sure they're taken care of for the rest of their lives. Y'all bring me back to picture over here.
So Rosemary, another question.
Yes, ma'am.
Here's the thing. Say for instance, they have a $100,000 policy and they have built up $50,000 in value. Do they have to cash the whole $50,000 out, or
No.
could they just take a portion
They
as
can
to
take
what
a
they
portion.
need at that particular
Yes,
time?
they can take a portion.
Tax free.
Tax free.
And the policy still remains in
In
force.
effect, yes. Okay.
You have all the good questions. All the good questions.
Yvonne said she's trying to help the people out there to make their needs. It is a
So that's such a good question because you see, the title is gift of a lifetime.
Yes.
So if I have 50,000, let's say my parents did this for me when I was a baby, now I'm getting ready to get married, and we need some money for our wedding, right? And I need $25,000. I take that. I still got another 25,000 in there for the future, and guess what? It's gonna keep growing because of the dividends and the interest in the policy. Every year it compounds and grows, even if I'm pulling from it,
Yes.
just like a savings account, growing at like a 4 or 5%. So yes, you can use it for the wedding, and I can use it for the babies, and I can use it to pay my college debt, and I can use it for whatever. No questions asked. Because here's the thing, there's other savings accounts and investments like your 401k or other things, but they ask you, like, what are you going to use it for? If it's not for something that they want you to use it for, you can't take it out. Or you have to borrow and then pay back. This one, you can do that. You can borrow, pay back. Like you're your own bank. You don't have to pay back if you don't want to.
So when you, suppose you say, well, I got an insurance on my son.
Right.
And I'm going for a while, and I didn't pay. I didn't pay every month. So they would take that money and pay my policy, pay that policy.
So that's another
like a loan?
question. So
No, I think that's correct.
they would actually take, credit union would actually take the dividends coming in every year to pay your premiums. So the cash value would remain. It wouldn't run out. They wouldn't use the cash value to pay for the premiums. They would use the dividends, which the dividends is like gift money. When you hear dividend, think a gift.
Yeah.
Every year there's a gift.
But when they ask you, they tell you it's a loan, so then you're paying on the loan. But when they mention it, it's like a loan.
You can take it like a loan if you want to. You don't have to take it like that. There's
So if you
different
don't
ways
pay
to
on
do
it, it's like, okay, he passed, God forbid,
Yeah.
they take that money before they leave.
I see what you mean. Okay. No, because the cash value is going to continue. They'll take it from the death benefit whenever he passes away, the insured, right? So here's the thing. Let's say, for example, I have 100,000 of death benefit, right? And I have 50,000 of cash value. I take 20,000 of cash value. Whenever the person passes, the insured passes away, they're going to give them 80,000, not 100,000. So, Cardina, they're going to take it from the death benefit,
Yeah.
not from the cash value. Is that making sense? Because the reason why is because they say, hey, you used it while you were alive. We're going to give the rest when you're gone. That's a very good question.
But I remember my mother passed away, something like that. She used some of her, at the time of her passing,
Thanks, guys.
they take, and they give her a whole.
Yes, correct. You got it.
It's just so wonderful. rather it be a mother, a father, grandparents, they're able to just take the advantage and opportunity to be able to share the special moments. Look at that, Herbie, that's you and Kalani. That's you and Kalani, our baby. All right, so now, why start now? Because the sooner you purchase protection, first column here, the more time the child policy has to grow its cash value. Cash value at age 25. Look at this. When you start them early down here, you start them at 0, like we were saying, 24 hours old. By the time they get up here, they've already aged 25, they're about 55,000. Wow. Think about if they're 10 years old. You start them when they're 10 years old. By the time they get to 25, they're about 40, I would say 42,500 looks like. All right, if you start them at 20 years old, by the time it grows in 5 years, they're probably at 11,500, 1,200. So, when we look at this column, the lower the guaranteed annual premium will likely be, since they typically are less for younger insured. Remember we were talking about annual premiums, yearly premiums. So remember we were talking about when you start a child out at 24 hours old, 1 day old, the younger that the children are, the cheaper that the policies are going to be. So the cheaper that you're going to pay for that policy, the annual premium over the year. So if you look at this, they've got someone who started out, newborn child, and the policy is $2,000 a year. By age 10, it's up to about 27.50 a year. And by age 20, it looks like it's about 32.5, somewhere over there in premium. So do you see the significance change? Do you see the difference when you start a child? The earlier you start the child, the more you're going to get in cash value that's going to be building for the child, and the less that you're going to pay in an annual yearly premium. You guys see that in this graph?
Oh, yeah.
This graph is so good. Because notice, if I'm putting $2,000 a year for about 20-something years, that's about 48,000 or so. I already have almost $60,000. That gain, what vehicle? It doesn't exist. Can you get that gain of almost $20,000 gain? No taxes on the gains.
Yes.
It doesn't exist. This is the only plan that you don't pay taxes on gains. And you can pull out when you're 25 years old. You don't have to wait till age 65, 59 and a half, so the IRS doesn't penalize you.
You know, it's amazing because a lot of times we can hear about it, people can talk about it, but some people learn visually. So when you are able to look at the graph, it makes sense. You know, there's a saying they have now, make it make sense. So this makes it make sense. All right.
I see you have it there, but I don't see the price of that. Suppose let's start with baby grandbaby. She's 5 what the homework what they have to give her for
Okay, this is what we would have to do.
Oh.
I can answer that right now. We don't even have to go on the graph. We would have to actually sit down. I would have to get her date of birth, and we will put it into my system, my dialing system. Hey, Rose. Because what happens is it's going to cost more to insure boys than it is girls. Girls are cheaper to insure. Yeah, boys are a little bit more expensive. Not a whole lot, but it's more expensive to insure a male than a female. We would have to take the date of birth of each child, each person, put it into the system, and then we would be able to run an illustration, and it gives us a quote of what it would be monthly. You can also, when you're doing a whole life, you can do what we call a CWL, which is a custom whole life. With the custom whole life, a regular whole life you can pay to 100, to your 100 years old, and so this covers your whole life. But if you wanted to say, I want to put a policy on my grandchildren, but I want them to pay 20 or 30 years, that's what we call a custom whole life. The only difference is it's going to be more expensive. It may not be drastic because they're young, they're not that old. But once we're running an illustration when we talk about it, then I'll be able to show you the difference in the custom whole life versus the whole life. Because you can pay for like a $100,000 policy or a $50,000 policy on a child and someone that's under 18. like your grandchildren. And then what happens is, if you don't want them to have a policy that they have to keep up and pay for it until they're 100 years old, then because you want to make sure they have it in place, you know what I mean? Then you can do it like 20 years, 30 years, 40 years, how, you know, like that. We can switch it up to a custom whole life. And it will be paid up in those years that you choose, but it's still going to cover their whole life. So it's a whole life policy or a custom whole life policy. So it will go by date of birth, okay? All right.
So Rosemary, for instance, if I take out a policy, and it's based on my health, correct? Is there anywhere down the line that is be a possibility if my health
Improve.
decreased?
Oh, decrease.
Is there a chance of New York Life dropping the policy due to my medical condition?
If you've already been approved, that's what you're saying?
Yes, if I'm already approved.
It's already in effect.
And I've been there for instance, maybe 2 years or maybe a year in, but my health, decreased. There's no chance that you guys will drop it.
No, and I'm going to tell you why. What I like about New York Life is this. They are very thorough. Our underwriting is very thorough. They go back 5 years. They're going to look at everything that's in your medical records, and they're going to offer or they're going to decline based on that. They're going to look at medical records. They're going to look at any type of comorbidities, things like that. So as long as your policy has been approved, it's final. It's finite. Then if something were to happen to you and you had some type of health decrease, then they're still going to cover you. They're not going to drop you.
Also, think about it for a child, right? The underwriting for a child under 18 is very different than the underwriting for an adult.
Yes.
So I'm gonna say it so you can see me. So for an adult, most of the time you have to do blood work. Why do they do that? See if there's nicotine in the blood, and see if there's this. They're gonna look up your medical history, like what Rosemary said. It's very thorough. For a child, it's an application and like 10 questions about their health, and that's it.
And that's it.
No blood work, no nothing, no. It's a kid. So let's say that kid is 5 years old. We're gonna just an example of a child. At 10, God forbid, there's diabetes. The policy continues. The price doesn't go up. The price remains. The premium remains the same as when that child was healthy. Same thing with an adult. If an adult now gets an illness or a sickness, the premiums remain the same no matter how much your health decreased. Very important. That's why a gift of a lifetime is a gift of a lifetime. You know why? You're locking in your child's health for the rest of their life. Think about a little girl. Now she gets married. Now she gives birth. Most women, after giving birth, they have some complications. There's blood pressure now, have an issue. Doesn't matter. They locked me in when I was 10 years old. And that's my health forever in the policy.
Yeah.
So, what is the least year that y'all sell a policy? Oh, you have to be before y'all not selling the policy. What's the age limit?
The age limit.
How little? 24?
No,
24 hours old.
say I'm grown and I want to buy a policy.
Okay.
How old do I have to be for y'all selling their policy?
The beginning age is 24 hours. And what we went up to 80, 85?
We're now 85.
85.
88,
Yeah.
so age 85, you
Yeah.
can purchase a policy. A whole life policy. Yes. So from literally day one
They want to age
being
85.
alive all the way to age 85.
So if I had to buy a life policy from you, what are you looking for? Health from
Yeah, it's going to be
selling me a life?
Health,
health.
they're gonna look at all the health history, all the medicine, all the times you went to the hospital, to the doctor, why, what happened. A lot of times they'll rate you, they'll be like, well, and I'll tell you, it's life insurance is easier to get than long-term care.
I was going to say that. I was
That's what I'm talking
I was going to throw that out there because I know where she's going.
Yeah.
And that's what
A life policy.
Yeah, a life policy is underwriting is not as severe as long-term care.
Yep.
I know you're a little shell shocked, man. It's okay. It's okay. She's a little shell shocked.
I knew where it was coming.
You knew where she was going, too, baby. children need more or less life insurance than you have today? Think about this. First of all, do we already have life insurance in place for our children?
No.
That's where we need to start thinking. Because a lot of times we're asking, do they have enough? But some children, they don't have any life insurance. Some adults, they don't have any life insurance. But that's okay. That's why me and Marie are here today. We're trying to educate y'all and help y'all out. Right? So, the gift of insurability. So buying whole life insurance for some now establish their ability to qualify later, even if, these are some of the questions we were talking about, guys, their health changes. Remember you were asking about if something were to happen to your mom? If they take up a risky hobbies or interest, if you decide to start mountain climbing, and you've got a whole lot of policy already in place, if you start bungee jumping, if you start jumping out of airplanes and parachuting, you already got a whole lot of policy, so you don't have to worry about that. You covered. All right? All right. All right. And think about this. When you got the policy, you were probably a child, you didn't have any risk, or you might have been a young adult, 18, 22, something like that, and you may have had a sedentary job where you were mostly in an office. But then all of a sudden you decide, I want to try something in construction. So now you're out in the field and you're hands-on, you enter into a physical, risky job, a career. Guess what? You already have the policy in place, you're covered.
I'm covered. So you don't reject me if I either made a loss of limb, I still want some insurance. You reject me, right?
No, I don't reject. You know, you're right. There's a story behind it. There's a story behind it. I'll tell you something. All right, guys. So what I want to say is this. When we think about it, think about the fact that if you don't have the insurance and you have a risky career, and you want to go where we have IDI, individual disability insurance, we go by risk categories, and that's a whole different policy though. So we do offer that as well, and that's where this comes in with the physical risks. We have to assess the risks and go from there, kind of see exactly where you fall. All right, so get a policy. Don't wait until you decide to go bungee jumping and all this stuff.
But that's why
parachuting.
I thought we'd be qualified to get a life policy. Right?
Maybe.
Maybe.
Yeah. What we do is we sit down and we
Not
do a
always,
policy.
not the only person. A life policy. So when they ready to kick
There's people that, let's say, for example, there's other clients we've had that they haven't been approved for long-term care,
Yes.
but they have been approved for life.
Yeah.
Okay.
It's different.
That's what I'm
Because
saying.
long-term care is morbidity
Yes.
and life is mortality, two different things.
Oh, okay. Okay.
Yeah, it's stricter. Long-term care underwriting is a lot stricter. It is. It is. All right.
I don't understand you when you come and you sit at my door, you would tell me all this.
Yeah. Yeah. And that's why we always say when we get ready to sit down with a client, that we have to see if you qualify.
Right.
Because the one thing we don't want to do is to build false hope. Anything that we do, we have to qualify for it. And I've been in a position where sometimes an agent or me as a person that's listened to an agent that's dealt with me personally would make you think that you're going to be approved and you may not be approved. So it works both ways. We just have to be forthcoming in anything that we do when it comes to life insurance. Then we have to see if we qualify. So that's why we make sure we get the right terminology, because you don't want to set up any false hopes or anything. Maria, you had something?
There's an agent that he's in our office and he always says, you don't buy life insurance, disability insurance, long-term care insurance. You don't buy it with money. You buy it with your health.
Yeah, and that's good. I like that. That's true. That's true, because we have to qualify. All right, so how the policy purchase option works. All right, $100,000. If we're starting out with a $100,000 policy down here, and what are these steps? Guaranteed coverage using the policy purchase option rider. And we put into a policy purchase rider option within this policy, then we can end up building up to 1.45 million.
So the policy, this is like, let's say a little kid, right? And they're like 5 years old, and they start with 100,000. I believe it's up to age 48. They can purchase more insurance. So they bought 100,000. Now I can purchase more insurance with this rider, if you want to add the rider, until I'm 48 years old. Let's say now I graduated college, I want more insurance. I got married, I want more insurance. So my policy's building, like Rosemary said, all the way up to almost 1.5 million. That is without health exams, without underwriting.
Because you put the PPO on your policy purchase option, right?
Huge.
And you know what I wanted to say, let me tell you, what I've learned since I've been here in New York Life is that when we're doing the policies, the way to build more cash value within the policy is to utilize the riders. It really helps. When you talk about the policy purchase option, like Maria was just saying, it does help you to build more value, cash value within that policy. Even though you started out with the 100,000, and like she said, what was that, like 40 years or something like that?
Yeah, it's usually until age 48 that
Yeah.
you can increase every time. You can increase by like 100,000
Yeah.
or 200. It depends on how much you put on the rider.
And you don't have to go back through underwriting, you don't have to do all of that. You can continually increase it based off of whatever the amount is that you put in, based on the policy purchase option.
Like, let's say the kid got 100,000 number 5, and now they're 15 years old, and now they're diagnosed with something. Policy purchase option, let's increase your insurance.
Yeah.
Nobody's gonna ask you if you're not diagnosed with an illness. It doesn't matter. Yep.
Yep,
It's huge.
it's huge. So, let's talk about why cash value whole life makes good sense, okay? We're gonna talk about the products. What other products, what other product does all of this? We have the guaranteed debt benefit when we're talking about whole life. We're concentrating on whole life here. Oh, the wheel, look at you. Thank you. We have income tax-free debt benefit. We have tax-free access to cash values. It is protected from creditors. It's tax-deferred cash value growth. We have additional growth through dividends, like we were talking about. Guaranteed cash value growth here, and premium guaranteed never to increase. That's the will you have. You got one? Okay. I know good job. I'm telling you. All right. So there's 4 different things we want to talk about here. All guarantees are based on the claim paying ability of the user. All right? The second thing we need to know is that the dividends, which provide an opportunity for cash value growth, are not guaranteed. Touch on that one, Maria, about them not being guaranteed for the dividends.
So let me explain something that Rosemary said. New York Life is a mutual company. There's only 3 mutual companies left in the entire United States because most companies demutualize because it's to their benefit, not to the client's benefit. We have stayed mutual because it's to the client's benefit. Since 1845, we have been a mutual company. A dividend is a company's earnings. There is no company on planet Earth that can guarantee their earnings. Doesn't exist. You can't do it. However, New York Life has paid dividends every single year in a row without missing out since 1854. What does that mean? New York Life had gains as a company and paid out a gift to the client, monetary gift, to increase and compound their policies during World War I, World War II, the Great Depression of the 1920s and 30s, COVID, 2008. They were paying dividends. When the stock market was crashing, negative 40%, New York Life was paying dividends in their policy to people. So no, they can't be guaranteed. No company can guarantee their earnings. But they're kind of basic. Like if there's a World War III, we're paying dividends.
Yeah, we're going to get our dividends. Thank you, Maria. So the third thing is that it varies by state and may be limited when we're talking about all of these options here for the products. All right? Just like Florida may have something in our policies with New York Life, whereas to California does to, what was that? I can't even remember, but it was something that wasn't offered here, but it was, oh, I know what it was.
A rider, maybe?
I know exactly what it was. I had an inquiry about someone who has a immunodeficiency problem, diagnosis rather, not really a problem, a diagnosis. Whereas Florida does not write it in New York Life, but California does. That's what it was. You kind of probably caught that when I remember. Okay.
Same company.
So that's what it's talking about. Yeah, same company. But it was something to do with it was political, something that they had to write into California. That was the change why California is able to, but it doesn't guarantee that the person with the immunocompromised disease would be covered in California. It's just that they can't not take the policy. They have to take the policy, but it doesn't mean that they're going to be insured. So that was the one thing. So that's why it varies by state and limited. It's limited by states. So what Florida may offer, California may not offer, or what California offered in this case that I found out for one person, Florida did not offer because we don't write in Florida for it, but they're able to take the policy in California, but it doesn't mean that it's going to be a guaranteed yes from underwriting, okay? So that's what that's talking about. The fourth thing is assuming that the policy is structured properly. You can access the cash value, generally tax-free, via partial surrenders, withdrawals, available cash surrender value, and life insurance benefits. Loans also accrue interest. So those are the different areas that we want to talk about when we're talking about the whole life. It kind of illuminates, gives you an idea of what you're dealing with when you're talking about purchasing a whole life, the options that you have, how the cash value grows, things like that. Any questions? Oh, y'all good. Let me hurry for you. Glory. All right. It's a win-win, people. Look at that. You are taking advantage of these valuable benefits and helping them to start their financial future. Look at that. That's me in Kalani. All right? All right. The cash value in this policy grows tax deferred, allowing for maximum compounding. All right. So the key considerations when we're talking about whole life. A whole life policy can last the child you love his or her entire lifetime. The death benefit is generally tax-free, probate-free, and a way to pass on your legacy. Let's talk about being probate-free. A lot of times what happens when it comes to an inheritance that you've left for a loved one, if there are children in place, there's no living will, things like that, what happens is your property, your estate, whatever you leave behind, if you have 4 or 5 children, even 1 or 2, it's going to go into probate. So it can stay in probate for many years. But the good thing about this insurance is that it's probate free because you're able to go ahead and assign your beneficiaries. If there's someone that's younger than they should be, you're able to also have like a contingent beneficiary or someone like that to make sure that your estate doesn't fall into probate when it comes down to the life insurance policy. Okay? Y'all quiet out there. Why y'all so quiet? Y'all too quiet. Okay. The cash value can be used to start your little one down the road into a great financial road. Look at the little key up there. Give them the key to a future. That's powerful. That'll preach right there now. So the sooner you get started, the more cash value that accumulates, and the lower the premium should be. Remember we were talking about the younger that you start off with these children or grandchildren, the less you're going to pay in a premium, your annual premium, your monthly premium, over time, because you start them at a younger age, just like the graph shows us. And the money is going to build up more. You're going to have more cash value in that policy. All right, let's talk about transfer assets via a premium deposit account. All right. So, first of all, what's a premium deposit account? First thing we need to know is you can prepay up to 14 annual premiums on certain type of life insurance products. And there are 9 different ones in California that you can pay up to 14 different annual premiums.
And then in Florida.
Florida has some as well, but in California.
California has 9 years.
attractive interest rate on the money you deposit and lower out of your pocket costs. It lowers your out-of-pocket costs here. Okay, we're talking about the premium deposit account. And the third thing we need to know is it can guarantee that premiums will be paid, even if you aren't there to pay them. Like we were talking earlier, I think Carnegie bought a coin or Yvonne did, and we were talking about if something were to happen to you, what happens to the policy. So when we talk about the premium deposit account, that right here, it's a guarantee that the premiums will be paid, even if you aren't there to pay them.
For many years.
So this is very important.
Okay.
Rosemary, can you some more?
Y'all gotta give us a meeting.
It's so important because it's exactly what you're saying, and a lot of grandparents, they do this. It's a one-time payment. So some grandparents, they say, you know what? Instead of paying every month, $100 every month into this and saving $100 every month for my grandchild, I'm just gonna put away $10,000. Here you go, Rosemary, $10,000. You never have to think about it again, you never have to look at it again. Those $10,000 are gonna grow at a guaranteed 5%. Currently, it used to be 10%. You might go back to that. Now that interests are, fluctuating. But you want to put yourself in a position and say, okay, let's say I'm getting closer to my 70s, my 80s. I don't know how many years I have left. If I do a premium deposit account, I know that this policy is going to be paid up forever. So I put the 10,000 grows at 5%, and that money is paying my $100 a month. Is a premium deposit account. It's like a CD. You guys ever had a CD before? In the bank, you put CD, it's growing, right? It's like a little savings account. But that account is what's paying the policy for the child. So even long after you're gone, the policy is going to continue to pay itself. It's a premium deposit.
Awesome.
So he did for, I am in Rosemary, $10,000.
Right.
Okay. And it's gonna be, will it stay at that particular rate percentage?
Yes.
But does the percentage rate changes as the years go
Great
on?
question. Depends on what you locked in.
Yeah.
So there's people that last year premium deposit account was at 12% last year. Guaranteed increase. So if I had 10,000 every year, it was increasing 12%, guaranteed. So if I lock that in there, I'm getting more money. So I'm kind of getting the insurance on a discount, if you think about it, because my money is growing so much that then I'm paying, the premiums that I'm paying, the cash value is going to be much more than what I put in. So you get double interest. You get interest gains, growth on the PDA, what we call PDA, premium deposit account, and then you get growth on the cash value as well. So now, the interest gains on premium deposit account are taxable every year. That's the only thing. Every year you're gonna get a 1099. It's gonna say, hey, 10% growth, you have $1,000 growth in here, you gotta pay taxes on that. Because that's an investment. It's a true investment. It's like it was, however, now that money's going into your whole life, the cash value is tax-free. But you can't double dip on this one. Because this is like investing in the CD, in stocks, but it's guaranteed. Anywhere you invest, any bank you invest in, you can be taxed. Except for life, which is where this money's going to after this.
Y'all good? You're so quiet. I think you're so innocent. Maria don't think they're always this quiet. They're not this quiet. All right, the next steps. All right. Now we need to meet to discuss how best to act on your love for your family, your loved ones, and to protect that? We
Yeah.
can just do
Those
it
are
that.
some- those are some things.
You guys can grab something to eat or
Some
drink.
snacks. Yes, we grab some snacks. We're gonna switch gears a little bit now, and we're gonna talk a little bit about retirement planning. When you think about a financial plan, you're thinking about a house, and the foundation of a house is the most important piece. That foundation is insurance, which Rosemary just talked about. That has to be, that's why getting it when you're a baby is so important. The foundation of the house. After that, we start building the house up. That's accumulation. That's what we're going to talk about now. And the roof of the house is the legacy. So when you think about what is my financial plan, what should it look like? Think about a house. Foundation, protection. A house, the middle of the house, accumulation, structure. And the roof is preservation, which is what am I going to leave as a legacy to my family. So we're going to talk a little bit about accumulation.
Give me just a moment.